Two people, same salary, same opportunities, same intelligence. One retires a multimillionaire. The other dies broke. What's the difference? It's not intelligence. It's not luck. It's not even how much money you make. It's psychology. The Psychology of Money by Morgan Housel reveals a shocking truth. Managing money has almost nothing to do with math and everything to do with behavior. You can be a genius and still go broke. You can be average and become wealthy. Because wealth isn't about what you know. It's about how you behave. Today I'm breaking down the 20 lessons that explain why smart people make terrible financial decisions and how you can avoid their mistakes. Welcome to the Knowledge Nexus, where the world's greatest ideas connect. Let's unlock the psychology of wealth. What's up, Knowledge Nexus? I'm your name, and today we're connecting the dots on one of the most important finance books you'll ever encounter. The Psychology of Money by Morgan Housel isn't about stock picking or investment strategies. It's about the invisible forces that control your financial decisions. Published in 2020, this book has sold millions of copies because it answers the question everyone's asking: why am I not rich yet? The Nexus note from the Psychology of Money. Doing well with money has little to do with how smart you are, and a lot to do with how you behave. Think about that. Your financial success isn't determined by your IQ. It's determined by your psychology. This connects directly to what we've learned from Rich Dad, Poor Dad. Financial systems matter more than income. Think and Grow Rich. Mindset creates reality. Atomic Habits. Small behaviors compound over time. Morgan Housel shows us why these principles work by revealing the psychological truth behind money. Let's dive into the 20 lessons that will change how you think about wealth forever. Lesson 1. No one's crazy. Here's Morgan Housel's first insight. Everyone makes sense in their own mind. The way you think about money is shaped by your unique experiences. Examples. If you grew up during the Great Depression, you'll never trust the stock market. If you became an adult during the 2008 financial crisis, you'll be terrified of debt and housing. If you came of age during the Bitcoin boom, you'll think crypto is the future. None of these perspectives are wrong. They're just different. The problem? You assume everyone has the same money experience as you. They don't. Your coworker who spends everything? Maybe they grew up poor and never saw money as something you could save. Your friend who hoards cash? Maybe their parents lost everything in a crash. The insight. Your personal experiences with money make up maybe 0.000000001% of what's happened in the world, but maybe 80% of how you think the world works. We all think we're being rational, but we're just operating from our limited experience. Connecting the dots. This connects to behavioral economics. We're not rational actors. We're emotional beings with biases. Understanding this is the first step to making better money decisions. The takeaway. Study history. Understand that your experience isn't universal. Be humble about what you don't know. Lesson 2. Luck and Risk. Morgan Housel tells this story. Bill Gates went to one of the only high schools in the world with a computer in 1968. That's insane luck. But his best friend, Kent Evans, was equally smart and had the same opportunity. Kent died in a mountaineering accident before graduation. Same intelligence. Same opportunity. One became the richest man in the world. One died young. That's luck and risk. Two sides of the same coin. The hard truth. Success is never 100% skill. Failure is never 100% bad decisions. Luck plays a bigger role than we want to admit. The problem? When we succeed, we attribute it to skill. When others succeed, we attribute it to luck. When we fail, we blame bad luck. When others fail, we blame their poor choices. This is called the fundamental attribution error. The insight. Nothing is as good or as bad as it seems. Practical application. Don't worship successful people as geniuses. They had luck. Don't dismiss failed people as idiots. They had. Lesson 3. Never enough. Rajat Gupta was worth $100 million. He committed insider trading for a few million more. Went to prison. Bernie Madoff had billions. Ran a Ponzi scheme for more. Died in prison. Why? Because they didn't know when to say enough. The hardest financial skill. Knowing when you have enough and stopping. Housel says, there is no reason to risk what you have, and need for what you don't have and don't need. The goalpost problem. You think, when I make $100,000, I'll be happy. You make $100,000. Now you want $200,000. You make $200,000. Now you want $500,000. The goalpost keeps moving. The solution. Define enough for yourself. Then protect it. Don't risk it for more. Lesson 4. Confounding compounding. Here's the most important concept in all of finance. Compound interest. Warren Buffett's net worth is $84+ billion. But here's the key. $81.5 billion of that came after his 65th birthday. He's been investing since age 10. But most wealth came in his later years. Why? Because compounding doesn't work linearly. It works exponentially. The math. $100 at 10% annual return. Year 1, $110. Year 10, $259. Year 30, $1,745. Year 50, $11,739. Same $100. Same 10%. But years 40 to 50 generate more than years 1 to 30 combined. The insight. Good investing isn't about earning the highest returns. It's about earning pretty good returns that you can stick with for the longest period of time. Warren Buffett isn't the best investor ever. He's just been a good investor for the longest time. The mistake people make. They chase 20% annual returns and blow up. They should chase 8 to 10% returns and never stop. Connecting the dots. This connects directly to atomic habits. Small consistent actions compound over time. This connects to rich dad, poor dad. Assets that generate cash flow compound. The takeaway, time is your most valuable asset. Start early. Stay consistent. Let compounding do the work. Lesson 5. Getting wealthy versus staying wealthy. Getting rich and staying rich are two completely different skills. Getting rich requires taking risks, being optimistic, going all in. Staying rich requires avoiding risks, being paranoid, protecting what you have. The problem. The personality that gets you rich will make you poor if you don't change it. Examples. Lottery winners, they get rich overnight. 70% go broke within years. Why? They never develop the skill of keeping wealth. Athletes make millions. Many go broke after retirement. They knew how to earn, not how to protect. The survival mindset. Housel reveals, more than I want big returns, I want to be financially unbreakable. The 3 rules of staying wealthy. 1. Survival. Your number 1 goal. Don't lose money. Survive to fight another day. 2. Humility. Acknowledge that what worked yesterday might not work tomorrow. 3. Paranoia. Always assume something bad could happen. Plan for it. The barbell strategy. 90% of money in safe, boring investments, index funds, bonds. 10% in higher risk opportunities. This way, you can't blow up, but you can still benefit from upside. Connecting the dots. This connects to Nas and Taleb's anti-fragile build systems that benefit from chaos. This connects to think and grow rich mindset must evolve. The insight. Different games require different strategies. Play the long game. Lesson 6. Tails, you win. Here's a stat that will blow your mind. In venture capital, 65% of investments fail completely. But the 35% that succeed generate all the returns and then some. One Amazon makes up for 50 failures. What this means for you. You can be wrong most of the time and still do great if you're right on a few big ones. Examples. An index fund owns 500 stocks. Most will be mediocre. But 7% of companies generate all the market's returns. Your career. Most jobs will be okay. One or two will change your life. Your network. Most connections won't matter. A few will be transformative. The insight. A few things account for most results. How to apply this. 1. Diversify. Don't put everything in one bet. Spread bets so you catch the outliers. 2. Stick around. You can't catch outliers if you quit. Stay in the game long enough to benefit from tail events. 3. Accept failure. You'll be wrong often. That's fine. Just don't let one failure wipe you out. Connecting the dots. This connects to Pareto principle, 80-20 rule. 20% of actions generate 80% of results. The takeaway, you don't need to be right all the time. You need to be right on the big ones and survive the rest. Lesson 7. Freedom. Morgan Housel's most powerful insight. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. Not a yacht. Not a mansion. Freedom. The ultimate luxury. Control of your time. No boss. No debt. No stress. The ability to say no. Money's greatest value. It buys you control. Over your schedule. Your choices. Your life. The mistake. People buy expensive things to signal wealth. But that actually reduces freedom. More bills, more stress, more work. Real wealth is invisible. It's the money you didn't spend. Lesson 8. Wealth is what you don't see. You see the nice car, the big house, the luxury vacation. You don't see the debt, the stress, the lack of savings. Housel's warning. Spending money to show people how much money you have is the fastest way to have less money. Real wealth. The millionaire next door drives a used Toyota. Lives in a modest house. Has $2 million invested. The broke neighbor drives a BMW. Lives in a mortgaged McMansion. Has $0 saved. Who's actually wealthy? The insight. Wealth is what you don't spend. It's the cars you didn't buy. The upgrades you skipped. The money sitting in index funds compounding quietly. Connecting the dots. This connects to Rich Dad Poor Dad, assets liabilities. This connects to minimalism movements. Less stuff equals more freedom. The takeaway, true wealth is invisible. It's what you've accumulated and not spent. Lesson 9. Save money. Here's the ultimate financial advice. The only factor you can control is your savings rate. You can't control market returns, the economy, your salary to a point. You can control how much you spend, how much you save. The math. Someone earning $50,000 saving 50% equals $25,000 saved per year. Someone earning $150,000 saving 10% equals $15,000 saved per year. The lower earner builds more wealth. Housel's insight. Building wealth has little to do with your income and a lot to do with your savings rate. How to increase savings. Not earn more hard, but want less easier. The enough principle. Define enough, then save everything above it. Lesson 10. Reasonable rational. Here's a controversial take. It's okay to make financially irrational decisions if they make you feel better. Example. Paying off your mortgage early isn't the mathematically optimal move. You'd earn more investing. But if it gives you peace of mind, do it anyway. Why? Because money isn't just math. It's emotion. A decision that makes you sleep better at night is better than a decision that maximizes returns but stresses you out. Housel's rule. Aiming to be mostly reasonable works better than trying to be coldly rational. Application. Want to keep 6 months cash even though it loses to inflation? Do it if it makes you feel secure. Want to own your home outright? Do it if the piece is worth it. Want to invest in something you understand versus maximum returns? Do it. Connecting the dots. This connects to behavioral economics. We're not rational, we're human. This connects to atomic habits. Sustainable systems beat perfect systems. The insight. Do what you can stick with long term, even if it's not perfectly optimal. Lesson 11. The seduction of pessimism. Why pessimism sounds smarter than optimism. The world is going to collapse sounds more intelligent than things will probably be fine. But here's the truth. Over the long run, optimism wins. Markets go up. Technology improves. Life gets better. Housel's data. Despite countless crashes, wars, and disasters, the stock market has always recovered and gone higher. The problem? Pessimism gets more attention. Everything's fine doesn't go viral. Market crash incoming does. The takeaway? Be optimistic long term, but prepared for short-term chaos. Lesson 12. Room for error, margin of safety. This is the most important lesson in the book. The most important part of every plan is planning on your plan not going according to plan. Examples. Don't save for 20 years of retirement. Save for 30. Room for error. Don't invest money you'll need in 5 years. Only invest money you won't touch for 10 plus. Room for error. Don't assume your job is secure. Have 6 to 12 months emergency fund. Room for error. The rule? If something can survive 80% of worst-case scenarios, it's good. If something can survive 100% of worst-case scenarios, it's great. Buffett's approach. He could take way more risk. But he doesn't. Because survival matters more than maximizing returns. Connecting the dots. This connects to anti-fragile. Build systems that benefit from chaos. This connects to atomic habits. Never miss twice. Plan for setbacks. The insight. The best plan is the one that survives when everything goes wrong. Lesson 13. You will change. At 18, you want to travel the world. At 30, you want a family. At 50, you want peace and quiet. Your goals will change. Plan for it. The mistake? Making irreversible financial decisions based on current desires. Example. Taking on massive debt for a lifestyle you want now. But in 5 years, your priorities completely shift. Housel's advice. Avoid extreme financial decisions. Stay flexible. Avoid debt that locks you into a path. Lesson 14. The man in the car paradox. You see someone driving a Ferrari. You think, wow, I want people to respect me like that. Here's the truth. No one's thinking about the driver. They're thinking, wow, if I had that car, people would respect me. The paradox. People buy luxury items to get admiration. But the admiration doesn't go to the person, it goes to the item. What actually earns respect? Humility, kindness, wisdom, financial independence. The insight. People generally aspire to be respected and admired by others, and using money to buy fancy things may bring less of it than you imagine. Connecting the dots. This connects to the hedonic treadmill. Material things don't create lasting happiness. Let's connect the dots. Here are Morgan Housel's most powerful lessons. The psychology of money principles. Behavior intelligence. How you act matters more than what you know. Luck and risk exist. Be humble in success. Compassionate in failure. Know what enough is enough. Don't risk what you need for what you want. Compounding is magic. Time is your greatest asset. Getting rich is not equal to staying rich. Different skills, different strategies. Outliers drive returns. A few big wins make up for many losses. True wealth equals freedom. Control of your time is the ultimate luxury. Wealth is invisible, it's what you don't spend. Save aggressively. Your savings rate is your superpower. Reasonable, rational. Do what you can sustain emotionally. Be optimistic long term, but plan for short-term disasters. Build room for error. Plan on your plan not working. Connecting the knowledge nexus. This book connects to Rich Dad, Poor Dad. Financial behavior creates wealth, not income. Think and grow rich. Mindset shapes financial reality. Atomic habits. Small money decisions compound over time. The pattern. Success equals right psychology plus right systems plus consistent behavior plus time. That's it. That's the formula that appears in every great idea we've studied. So that's The Psychology of Money, one of the most important finance books of our generation. Your action step: pick one lesson from this video and implement it this week. Define your enough number. Increase your savings rate by 5%. Build room for error in your budget? Stop trying to impress people with stuff? Just one. Start there. Drop a comment. Which lesson hit you hardest? What are you going to change? And here's the big question for the Knowledge Nexus community. What ideas should we connect next? We've covered wealth psychology, habit formation, mindset, and financial systems. What's the next piece? If this added value, hit that like button and subscribe. We make new connections every week. I'm Knowledge Nexus, and remember, doing well with money has little to do with how smart you are, and a lot to do with how you behave. Change your behavior. Change your wealth. See you in the next connection.